So today's clubhouse session, mainly I just wanted to go over like some risk management strategies and kind of go through and ask what our notables did today and how to, hedge their portfolios or if they stayed cash, and just kind of listen to their strategies on what to do when, we see such a red day. And obviously there's so many new, I guess, retail investors that kind of hopped in on the markets during like December, January. Obviously we all know of the GameStop, GameStop to the moon. And with that, a lot of new people kind of joined the market at this high, essentially. Not many people have that experience. The market in 2020 in general was super volatile, lots of ups and downs, and some people probably got burned, maybe lost a little bit more than maybe 20 to 30% of the portfolio I've been seeing. So definitely wanted to host this session for educational purposes and for some of our experts to share their experience so that in the future, maybe you can avoid getting dumped on. So quick three, I guess, really quick notes from my side. I did make a TikTok 2 days ago on Tuesday, kind of just going over, because Tuesday was a red day as well, and kind of just going over like the three things that I kind of remind myself on a red day. Number one is to just kind of keep calm, keep a cool head, and just don't be so quick to cut all your positions, or aka panic sell. Number two is it's kind of an opportunity to reset and reevaluate your positions. When we're in a bull market, we kind of just want to buy everything thinking that, these positions are good positions and will go up. But I think on red days, it's a good chance to reevaluate and like really see if these are good conviction plays, or are they like just plays you bought in because you blindly followed someone, or you're YOLOing, or you think it's going to go up. So reevaluate your position, maybe cut some position sizes to reduce market exposure, or just cut losses as a whole if you think it's not a position worth staying in. And then third, the market is a huge mental game, and it's very emotional driven. And I think red days are the days where we get tested the most. It's all emotional discipline, right? And obviously, and mental health, I think, is also very important because nobody likes losing money. Red days suck. Waking up to see so much red and you're down X amount in a certain position is definitely not, so I think just listening to some of our notable traders, some of the people up here have bigger portfolios. They're probably down a big amount, but listening to how they kind of deal with red days, I think would be really helpful. And before I start, we do have one of our new notable traders on Clubhouse, and I wanted to give him a chance to introduce himself, background, industry, how long he's been trading, and kind of his area of specialty. So Jimmy, you can quickly introduce yourself to the audience.
Hi, my name is Jimmy. I'm a systems engineer. I've been trading for about 15 years now. Really picked up trading when I was like 14 years old. I've been trading ever since. I strictly trade options. I don't trade shares at all. Although I have recently, some of the subs have got me into trading some shares, but mainly I do option strategies, and I usually do spread strategies rather than just naked share positions. And yeah.
Yeah, awesome. Yeah, Jimmy is kind of like our spreads expert. On Discord, he goes by Art of Spreads, or I give him that name. Also, I want to give a chance. Ryan kind of was able to speak last Thursday, but he didn't really give a self-introduction. So, Ryan, you can go ahead and also give a quick little blurb of yourself.
Yeah. Hey guys, I'm Ryan. I'm Blastoise on the server. Mainly what I do is just like day trading, scalping. Started trading back in high school. I'm currently in college now. Yeah, I don't know. I mostly do shares, so I do some scalping with options, but a lot of what I do is just quick intraday scalps. And you can find my Blastoise. That's
cool. Awesome. Okay, so I guess the first question, kind of the main question today, is how did your day go this week? Or how did your day go today or / this week? And what was kind of your trading strategy all week? And yeah, we could just go one by one to talk about it. And then later, I think we can just go straight into questions, and it'll be less of a structured, it'll just anybody who has an answer can answer. So how did your day go / week go this week, Jimmy?
It was obviously extremely red because so leading up to this kind of pullback, because I've been kind of anticipating a pullback or correction. I've been getting myself into a bit more long-term positions and putting myself into more of a cash position to buy this dip. So right now, because it kind of coincided with like a lot of the earnings, and then we had this kind of dip, a lot of options IVs are down. So it's kind of a nice time to kind of scoop up cheap leap opportunities. So if you're looking to get into long-term positions right now, I think it's a good time on options. So right now, that's what I'm doing. I think this may leg down a little more, in my opinion. But if it goes that way, then I'll just continue adding on to my long-term positions, just buying the dip. But if it does decide to go up the other way, I'm still set. So. It's not fun to watch your portfolio go red, but at the same time, if you're in longer term positions, you can anticipate the rebound. So just keep a level head, and just don't get too emotional when you see the red. When you see red markets, just think of it as a red tag sale, and be ready to scoop as many positions as possible.
Oh, and also, so sorry. Daniel is actually one of our new notables starting from this past week, so I wanted to give Daniel a quick chance to introduce himself as well. I saw you guys just join.
Hey guys, can you guys hear me? Okay.
Yeah.
Okay, cool. So I have been trading for 4 years and I am a day trader. I have been trading options and OTCs for about a year. I do work at Children's Hospital as a medical tech in the NICU and the PICU. Mostly I'm like a Ryan. Mostly I'll be scalping throughout the day. Typically on the backside. Um I my strategy is pretty much buy the wash and sell on the pop, and I'll be continuously doing that up, and I don't stick around all day either. Once I nail and bail, I mean, once I make enough money, typically I just nail and bail. Um, but yeah.
Yeah, Daniel's one of our traders that's very, because he has work as well. He kind of scalps in the morning, meets his daily target, and he's done. Oh, Kush is here. Cool. I'll invite him up to speak and mute yourself. We don't have to go through everyone's day. I guess anybody who wants to share can share, because I do want to kind of open up this floor earlier for people to ask questions. I'm just going to pick people. Quantum, can you tell me about your day today?
Yeah, my day was pretty bad. It was very red. My main trade was with Nvidia. I'm not Nvidia. Nvidia. So I've held this share for about 5 years, and so I've seen the good, the bad, the pretty, and the ugly of the stock, and so today was or yesterday was earnings, and so I was playing earnings, and I don't usually play earnings, but I felt particularly good about Nvidia earnings, and turns out it was great, but unfortunately the whole broader market just kind of like died, and I was kind of I was pretty leveraged in, but I was okay with the risk, and I went in basically covering all bases, and I was prepared for the worst, and the worst did come. So just to talk about that, so basically I put some hedge. I hedge with some puts, um, and I was prepared to buy the dip. So on shares, because I really believe in the future of Nvidia. They're like the king of semiconductors, and they're like a pretty safe play across all the industries like data server and AI and autonomous driving, and I just really believe in the future of this company. And so, you know, I was prepared that it was going to drop, and so it did, and still looking for a bottom and expecting, a bear market tomorrow as well. So I'm going to probably look for some shares to pick up. But yeah, that's about it. And I accumulated some shares because I swing trade a lot of other shares that I have, like Twitter. Twitter popped unexpectedly, and I just happened to have some options for March, and I kind of just sold it on a profit because it was kind of like a free gimme. I also hedge against the against SPY, so I bought some SPY puts, and that kind of rewarded me handsomely. And yeah, that's about it.
Yeah, anybody who bought SPY puts this morning would have been up at least 500 to 700%. I myself regretted not going into SPY puts. I decided to stay cash and not do much. But I later checked when the market, like before market closed, that it probably would have saved my portfolio quite handsomely today. But it is what it is. I did want to redirect to Eric. I know you, unlike the rest of us, kind of caught that GameStop second pop yesterday, and we're kind of writing profits this morning. How did that go? And also wanted you to share on why you decided to buy GameStop yesterday and kind of caught that so seamlessly.
Yeah, so definitely I was in the GameStop. I was in GameStop call options yesterday, going into today. So I guess I'm like one of the few that ended green. But initially the thought was it was 3 days ago when GameStop was like around 48.50. But I was just looking at the chart and it didn't look like it was going to go any further down. So it started to look like it was curling up too. So I thought it wasn't a bad idea to open a long position at $40, mainly because I feel like with a name like GameStop, right? Typically the way the market likes to move is you have the initial retail hype, which you see on the graph, the big jump from like 10 to 500. It dies down, people think it's over, and then there's some pointed period of time where it'll go up. You just don't know when, and we definitely saw that the yesterday and today actually. So that's what I mean. I think I just got lucky. Oh no, sorry. Going back to the flow, right? So I thought it was weird. I think Monday was when I started seeing some GameStop bets. I believe they were expiring that Friday, and so going back to when I opened that position and opened another one on the day before the run up, so yesterday was I was basically just looking at the order flow for calls, and there was a lot of bets for calls expiring this week, like tomorrow. And so I was just looking at the time, and I was looking at the order book for GameStop, and there was an increasing size of bets going into the close, and from there I was just like following the flow. I think at the time it was like around like 6 mil sweeps expiring 2-3 days, and so I just that kind of confluence gave me more confirmation bias to add on to my existing size. And what do you know, GameStop rips, and we have a rippity.
Yeah, so I think to kind of summarize what Eric said, two things. One, GameStop was sitting at a kind of like a support level, so there was a higher probability that it does kind of rebound from 40s. And two, he observed a lot of unusual call option flow that were expiring the week of in large amounts. So that's kind of why he went in, I guess, into the position. Two more questions. One for David, who kind of is more specialized in, selling puts, selling calls, and that strategy. How did this week go for you, and how did you hedge, or were you buying the dips, or were you selling puts? But yeah.
Oh wait, hold up. I want to go back. So I think
Okay.
I think it's very important, and I mentioned this yesterday too, when I was looking into the GameStop thing as to why it ran up. And I remember I was asking everyone was looking around. I'll ask Kush too, and one of the theories was that, just from like evidence alone, looking at, the sales, increasing sizes, looking at the price action. The price action definitely looked as though it was like either a short covering, combined with Momo buying. And so one of the theories was that there was possibly someone that was engineering for engineering, what's it called? Engineered the GameStop squeeze you saw 2 days ago, for a proxy for a move lower. And so, typically, typically when there's uncertainty in the markets and you're not sure what to do, I think that's very important, just to sit cash and just be patient, right? If you're a long-term investor, dollar cost averaging isn't a bad idea. But I digress. So, but yeah, that's like that's usually how I hedge typically. I did buy SPY puts this morning too, but cash is always a position.
Yeah, that's a really good point. Cash is definitely a good position. Going back to David.
Yeah, I mean, this whole week has been pretty red. I think I was down 10-12% today. Overall, from the top, I was down 30%. But I think overall, we were all anticipating a pullback, but timing that was the really crucial point. Starting in January, I think here every now and then people are loading up on SPY puts and just anticipating that pullback that never came. So when I was selling premium, I was selling on the put side and calls, like cover calls as well. But just based on the insane run up in bullish sentiments, a lot of the cover calls I was selling just kept hitting in the money. I had to either buy them back or roll them or whatnot. So it was really difficult to manage. So I stopped selling calls for a little bit, where I sold it extremely far out of the money with 2 or 3 weeks out. So there's more theta decay, so I can manage it a lot easier. So I wasn't really collecting too much premium, but it was still a decent amount. So when I was selling on the put side, I was looking on things that with really strong fundamentals that I wouldn't mind owning. And with the anticipation of the pullback, I was actually selling really far out of the money as well, but increasing time and adding more time premium to it. So, so some of them were even out. So March 19th and even April. So I was selling those. So for CRISPR, it was still hovering around 140s. Really great stock to own long term. Great fundamentals. Really nice company in the genomic space. So it was 140, so I actually sold like a 110 call. 110 put. I mean, is it gonna hit that in the next month? I highly doubt it. But in case of a huge pullback, I have a lot of margin, safety margin for not to get the price not to get in the money. And if it does, I have a lot of room to manage it. If I get a sign, that's fine. I'm buying a stock I really want to own for a really cheap, reduced price. But overall, there's a lot of stuff that are, falling, have a lot of credit spreads, or naked puts are open and really getting close. We're getting in the money. So it has to do with a lot of management and just looking at the overall sentiment. I did have to close some of my positions for a slight loss because I didn't want to deal with it going forward because of the uncertainty in the market. But overall, it was definitely a very tough market to trade in, especially if you're selling puts.
Yeah, for sure. Last question I have before kind of going on into just open discussion is for Kush and Austin, who are here more of the two more value investors. Everyone says to accumulate more shares on red days / buy the dip. What are some good value stocks that you guys think that we should look at on big red days? Austin, you can go first.
Well, for me personally, back in December, I sold basically all of my tech holdings because I didn't really think that this year we would have a strong year from the tech sector. So overall, every time we have an overall red day, I try to look at the materials, any like the cyclicals that really didn't get a lot of love earlier on in 2020, and they were still trading at pretty high discounts. So essentially, if you're looking high into the energy sector, there's still going to be that pent up demand from the travel that's going to come out with the vaccine rollout. People are anticipating we could get an infrastructure bill in the second half of 2021. So if you're trying to look at like materials plays or like industrial plays, mostly focused that like maybe if the company builds roads, like there's actually a ticker I'm looking at that's actually the ticker is road. So those type of cyclical plays I've been adding heavily on when we have dips.
Awesome. Any specific ticker names you want to drop?
Specific ticker names. Some people really like small caps. I would definitely recommend road, and primarily, I mean, based off the ticker name, they do a lot of road infrastructure building, which I mean, a lot of people could probably attest, especially here in America, that there's a lot of roads that do need a lot of improvement in this country. So that's primarily why I've been looking at them, because overall, I mean, if we do get an infrastructure build, there's going to be a lot of private and public spending on roads, in my opinion, that people will look to invest in. So road is definitely a strong stock that I'm looking at. And also this carrier for the people who like more stable plays, because due to the pandemic, a lot of people are more aware of the need for cleaner air inside of in overall public and also private homes. So Carrier is one of the leaders in HVAC, which is heating, ventilation, and AC. So being involved with them, they're going to get a lot of demand as homes, gyms, schools, hospitals all try to upgrade their outdated AC units. And if you're looking at materials, a lot of people at LKS have been playing Rio, which has a strong portfolio in iron ore and copper, which is a highly used mineral in the EV alternative energy sectors. And they also, when I was listening to the recent earnings call, they're going to be planning to enter into the lithium market for the future demand of EV. So if you're aiming long term, they're going to start doing into lithium, which is a very strong material to start getting into.
Love it. I always love your little DD spiels. Kush, I know you were bullish on Six Flags. That had earnings today, and they actually popped. I was watching them. Any other things you want to add?
Yeah, I think. Where do I start? I don't think. Well, first of all, you always introduce me as a value investor. I don't think I'm actually a value investor.
Oh, okay.
I think. No, it's not to say you're wrong. It's to say, like, I think people. I just want to clarify the difference. Value has underperformed growth for the last 15 years, right? Like materially underperformed. So if you're a value investor for the last 15 years, you're like, you hate yourself because you missed the entirety of the tech run. And so I don't think it's about being a tech investor or a value investor or growth investor. I think it's about picking your spots and knowing risk reward. Like, the whole reason this past week happened was because interest rates are rising faster than people expected because of inflation expectations. So that is something you could have predicted. Like, when COVID happened, the 10-year went from 1.6 down to, like, I don't know, 0.5. You knew COVID was temporary, and you knew the government was throwing out massive amounts of stimulus. So if you combine the two and markets reopen, in theory, you should get a lot of inflation. And when you get inflation, rates rise. And when rates rise, growth undervalues, or growth underperforms value because of the difference in duration of free cash flows. So when you take all that together, you know there's a vaccine coming. So things are about to open up. My guess is by May. You know you have trillions and trillions and trillions of stimulus coming that didn't exist pre-COVID. And you know all this is pent up because everyone's at home and has a lot of money and they haven't been able to spend it yet. And so Americans have saved $1.6 trillion in cash. So what that does is it's going to create massive amounts of inflation. And by massive, I don't mean like anything crazy. I just mean greater than 1%, which is where we were at the start of the year. And so you could have predicted that as reopening gets closer, maybe not the exact timing, but generally in 2021, the value should outperform because rates are going to rise. And I think this last week was an extreme example of that. So I made money this past week because I was in value, and I was actually short bonds using an ETF called TBT. That's an example of what you could do. Instead of reacting to markets, you can try to predict them. And I think too many people are stuck reacting and trying to chase what works and saying, oh, value worked today, so let me go by value. That's not how it works. It's more about figuring out what you want to own based on what your views are for the forward 6 months. So I think for the forward 6 months, I continue to see a reopening, stimulus, and the economy accelerating growth. We might have 8% GDP growth. America hasn't seen 8% GDP growth in 35 years. So we get 8% GDP growth, that is massively inflationary. And so, yeah, I think rates are going to continue to rise. I think growth tech continues to underperform, if not fall. I think Cathie Woods is going to absolutely blow up. I think Bitcoin's going to fall, because this is what happens when rates rise. And I think all of those are so contrarian to how people are positioned. I'd say, look, like, I don't know, I'm probably wrong. You just don't want to be over levered in one direction or any other direction. I think that would be general.
Quantum, I know you had a question for Kush. Go ahead and ask it.
Hey, Kush. So some of the audience is asking me to ask this question, but can you explain, I guess, the bond situation with what Jay Powell, what he has tried to do, and the correlation between the two, and how that will affect the stock market for the coming future?
Yeah, so inflation has perpetually... So the Federal Reserve has two mandates: to manage inflation and unemployment. And they're trying to balance the two. And I think for the past decade, unemployment generally has been too high relative to where they'd like it to be. And especially right now, because of COVID, unemployment's way too high based on what the Fed thinks. And so the Fed is willing to keep lower rates to stimulate an economy so that the employment rate returns to what they think is normal, quote unquote normal. That's why you've seen the Fed at 0% rate. So when COVID happened, they obviously dropped rates and they started doing everything they could to support the market. And that's all to support employment. I think what's happening now is the market's so forward-looking, and it's starting to understand that reopening is coming. It's starting to understand that a really, really strong economy is coming. If we have 10% unemployment, keep your working class constant, and GDP grows 8%, in theory, you just created jobs for all of them, and your unemployment fell to like 2%. So like, that unemployment is going to be gone in a year because of all this massive stimulus out there. And so the market's starting to recognize that, and it's starting to price that into like longer term bonds. And so that's what you're seeing happening.
Well explained. Thank you.
I just saw that LT hopped on. Would you like to give a quick introduction of yourself?
Yeah, can you guys hear me?
Yes.
Perfect. Hey guys, I think this is my first time on any sort of non-chat type of interface. So nice to meet you all. Is there a specific question or just an introduction?
Just kind of like your background, previous industry or current industry, what you do, type of trader.
Sure.
Yeah.
Sure. So I'm in finance. I'm in a corner of finance called structured credit, which is, if you know of mortgage-backed securities back from the 2008 crisis, that falls within structured credit. But I specifically focus on corporate loans, and I'm focused on business development / sales and trading in that kind of realm. On a personal basis, I've been trading since 1998. And so I've kind of gone through a couple of cycles, and I find this one to be very interesting. I have a background in options trading as well. In fact, that was my first job out on Wall Street. I was working for Wells Fargo in San Francisco. I'm in New York, and I'm an original New Yorker, but I moved out there in 2008 and was an options trader, both equity and commodity options. So I've done that on a professional basis. On a personal basis, I've done some option strategies, but have really focused on value bets for predominantly, and that, I think that kind of covers my background.
Cool, thank you. That pretty much is all I have for kind of just the Q&A question. I can open up the floor to anybody who has questions for some of the speakers here, or if we just wanted to discuss, you know, what happened to GameStop. Be interested to hear about everyone's opinion on that. But feel free to start raising your hands, and then we'll start inviting you up on stage, and just make sure to mute yourself once you guys are up here.
Oh, hey. I have a quick question for the scalpers and stuff. And also, Eric, great call on Jimmy. Like, he called it when it was like 61, and I was like, do I jump in? Do I jump in? I only bought a couple shares, but I wish I bought a lot more. Anyways, for the scalpers, do you guys keep SPY up on the screen and you look at it? Because I was green today only because you just kind of see like the pops of SPY, and then if the pop of SPY goes up, I obviously buy a stock, and then it just goes up, and then if SPY goes down, it goes down. Is that always the case for you scalpers or day traders?
For me, I do have SPY up on my screen on my TD Ameritrade. I actually have VIX on SPY, Tesla, Apple, but typically I just don't scalp large cap stocks, mostly like a low cap stocks. Like for example, today SSNT and then CDXC was the main play to scalp in and out. SSNT was the backside for shorts, but CDXC grinded up all day today, and it was really good to scalp in and out. But typically, I usually do have SPY up, just in general, if I'm scalping or not scalping.
I mean, yeah, to kind of add to that, as for, like small cap scalps, it's not as affected by, like SPY movements. So, if you're looking at like Nvidia or, like large cap blue chip stocks, that will have a correlation there. But for small caps, a red SPY just kind of correlates like, a very choppy market rather than, like actual movement in the pennies. So, like in the morning, I'll look at it and I'll keep it up, but like I won't take that too much into consideration when trying to enter a position.
I look at the Nasdaq generally because some of the smaller moves in SPY can be muted, but the Nasdaq is about 1.2 times beta of SPY, so I'll keep that up always just to see the overall momentum or change in direction. So it's I don't know, I don't use it for scalp trading. I don't scalp trade, but to get a general minute by minute or 5 minute by 5 minute sentiment of the market, I have Nasdaq up all the time.
Yeah, I think LT just mentioned beta. You have to be careful with that because, not all stocks have high beta, which is correlation to the overall market. And so you can't assume that, if SPY goes up, you pick a ticker and it's going to correlate, right? So that's highly dependent on the actual beta of that stock. So just be aware of that. If you're day trading or scalping, not all the stocks are correlated in that way or that highly.
Thank you.
Cool. Adding 2 more people to the stage.
Hey, my name is Addy, and I have
What's
a
up?
question targeted towards Kush, actually. Kush, you mentioned how it's due to the interest rates or possibly increase the interest rates that we're shifting towards value companies rather than growth companies, correct? And I was just wondering, and you made a distinction between, I guess, value and growth. And I want to know, where does Apple sit? Is Apple considered a value company right now, or would it be considered a growth company? Because also Apple took a lot of shit in this past week. But going forward, do you think Apple is also going to recover? Is it considered a value or a growth?
It's actually a really, really good question. Traditional logic or conventional finance people would tell you Apple's growth. There's a legitimate argument to be made that it's both, or it certainly was both earlier, call it 3-4 years ago, and it was one of the reasons why it had such a great move. And I think it was wrongly thought of as a growth stock. I think today, typically, a simple measure of it is look at the PE multiple of the S&P, which is what probably 21 times forward earnings right now, and look at the forward PE multiple of Apple, and it's probably in that low to mid 20s. So it's still like higher than S&P. So like kind of use the multiple that a stock trades you as a proxy of how value or growth it's deemed by the market, is what I'd say. So I think Apple would be in that definition of growth. I don't own any Apple or any indexes that own Apple right now because I would consider it growth. But there's a legitimate argument to be made that it is value.
Okay.
I'd be one of those people who would say it's value, and I treat it like value. And with response to your question, I think it's a great question as to why it would be considered value. So growth versus value and inflation's or interest rates effect on that is purely a calculation of when you're getting your cash. So when you buy a stock, you're buying a stock because you are getting all the future cash flows from that stock, which will traditionally come to you in the forms of either dividends most of the time or stock buybacks. And so the reason growth stocks get crushed when interest rates go up and inflation goes up is because the discount, your kind of willingness to hold something increases. So for example, a growth stock like take one of the EV battery names that's pre-revenue, pre-profit, pre-revenue. They're not going to start paying dividends probably for 5 to 10 years out. So when interest rates go up, your discount of that future dividend goes up, and that it makes that future dividend worth a lot less to you in present day terms. So stocks that are value stocks, they're considered value stocks because they're paying now, and the profile of the payments to you is generally shifted more towards the present. And one way to kind of filter for that is obviously to look at stocks that pay dividends. And Apple, while it pays under a 1% dividend, which is less than the S&P, it's not a zero dividend stock like you would find on more than 50% of NASDAQ.
Okay, nice. Gotcha. So just a quick follow-up then. So you guys are suggesting if interest rates are going up, obviously you would want, I guess your risking premium should also increase with that, right? Is that practically what you guys are saying, correct? Because if interest rates are going up, you can get a secured, I guess a guaranteed return through bonds because you have higher interest rates now. So they also would want a higher premium or at least get a better discount on the stocks, correct? And I guess, Kush, you mentioned that one of the ways you look at it is the PE ratios. If the PE ratios drops enough, and that means it's discounted enough, and that goes back to what Al was saying. Once it's discounted enough, you go and buy it. So what's the PE ratio that you're talking about? How do you compare? Like how do you know which PE ratio is good? Do you look at the historical PE ratio, or do you look at like relative PE ratios? Do you look at relative to the SPY, like you mentioned, or relative to like other value stocks?
Yeah, I can answer the second half of that. It's a good question. So, I guess the easiest way for you to look at it, it's tough because it's not easy to find forward estimates for retail investors. So you don't necessarily know what the forward PE multiple is, especially not on a year 2, year 3 basis. So I think it's kind of obvious when you look at call 2019, because at the end of 2019 the market was at a pretty euphoric multiple, and you can compare what multiple that stock was trading at that time as well as a relative indication of how value or growth it's deemed. I think that's probably the easiest way for you to do it.
Yeah, I'd just say that it's not necessarily as simple as comparing to some benchmark where it's the median, over the past 30 years, the median PE ratio for the market has been, 15, and we're at 25 now, so it's overvalued. It's one of the metrics that goes into the equation. You could justify a large PE if you can justify future earnings that are earnings growth that's very high. You can also justify a large PE ratio if if the other places in which you park cash, for example, bonds, the yields are low, so your cost of capital is low for equities. So it's not, there's no easy answer to it, but I would say that, so if you look at, I follow equity analysts and what they think about the general market. There's about 18 of them that are valuable to listen to, and they're all always wrong every single time, but it's important to listen, important to read what they say. And they're so wrong, for example, that the Citigroup and the Bank of America equity analysts, they, all the analysts came out with new forecasts in June of this past year. Normally they only do one forecast, which is December for the next year, but given COVID shook up the markets, they had a interim forecast, and two of them were predicting S&P at 2,600 and 2,700 for by the end of December 2020, and obviously they were off by 1,000 points. The overall kind of median now for the prediction is S&P at 4,200 by the end of 2021. And it's a pretty tight-knit group. I would say there's no kind of there's no outlier in terms of what they predict, but they all justify that prediction based off of earnings, future earnings by companies that they've pegged around 175 or to 180 per share on the S&P, and that could vary a lot, and that'll that could keep your 25 multiple. And then suddenly, yes, we could see 4,200 to 4,400 on the S&P, or they could be off by 1,000. They were off by 1,000 when they were only trying to predict 6 months. So they could easily be off by 1,000 when they're trying to predict for 12 months. And the earnings they may get right, but the market may not want to absorb a 25 multiple anymore, and it may revert to a 20 multiple. And so there's multiple metrics you have to kind of keep into kind of consideration. It doesn't just come down to what your earnings are and what you're willing to pay for those earnings.
Yeah, just to clarify, I don't think anybody listening to this should be using multiple as a justification for any investment. I think if you're on Google Finance and you see PE and some number, like literally ignore it. It's irrelevant. Because number one, that number's wrong because you're probably looking at trailing 12, not forward 12. Number two, you don't know if the street has the right numbers or not, and you're not close enough to the company to have a more accurate view on earnings than somebody who is doing that. So why bother playing a rigged game? Like you shouldn't bother. And even if you somehow knew the correct PE multiple, you're like, maybe it's there for a reason, right? Like markets are generally pretty smart. Companies have high or low PE ratios for a specific reason, and those multiples usually change when that reason changes. So I would say focus on why the reason should change. So for example, 2 years ago, you could have said, I think the penetration of electric vehicles will be a lot faster than what people expect. If that was your thesis, then you could have played that by being long Tesla. But you didn't go long Tesla because the PE was low. It didn't have a PE. It still doesn't. It doesn't have earnings. So even if it did have earnings, it would probably look really high. And you'd be like, well, that's expensive. And that would be stupid. So I'd say focus on themes that you want to appreciate, not on multiples, because chances are something trades where it does for a reason, and you probably don't even know what that real multiple is. So why bother? Like, you should really more follow themes.
All right, nice. Thanks, guys. I guess the reason I also brought this up is because I bought calls for Apple, and they expire a month from now on March 26th, and I want to get your thoughts on that. This is open to anyone on the floor. Did anybody else buy calls for Apple?
I bought a ton of March 19 calls, so I'm in there with you.
Nice.
Not financial advice.
Oh, absolutely not. No. But it gives me confidence that at least I got apes with me.
Yeah, great question. I loved your questions, Addy. Moving on to Sharish.
Yes, hi everybody. I love the community LKS on the Discord, and this is a great format. So really enjoying this. My question was general about 3x leveraged ETFs. I haven't heard much in the community about those. I've invested some in the semiconductor SOX L, and then also in the regional banks DPST, and they've been doing really good. I was just curious what you guys think about investing more or in particular sectors or in general just using 3x leveraged ETFs.
Someone else wants up. You can go.
Yeah, I would say that 3x leverage ETFs are a really interesting instrument. They have obviously very, very high rewards, but it comes with high risk as well. So in order to achieve the 3x leverage, these ETFs invest in a lot of derivatives. So I would say just be careful. They should be used, in my mind, as sort of either short-term hedges or short-term holdings, because you will incur what's equivalent to like data decay by holding these long-term. So I think high risk, high reward is kind of the bottom line for these 3x ETFs.
Decay is also mathematical. I was going to say that decay is also mathematical. If you go down 3% day one and you go up 3% day two, you're not at the same number. You're at a lower number.
And what Kush means by that is the reason you're at a lower number is you have to rebalance every day to be able to give new investors or investors at any given moment the same upside as they have the downside. So if you're down 3%, you have to literally rebalance the portfolio so you won't recover the full amount when you're up 3%. I know that sounds very confusing. I can send you, if you send me a message, I can send you a website that kind of shows you the mathematical reason as to why it has to rebalance every single night, and you're essentially taking asymmetric risk, meaning that even if the market has a 50% chance up and 50% chance down, your net risk on a 3x levered is like 52% down, 48% up.
I get that conceptually, but if you just see the performance, it's mind-blowing what semiconductor 3x has done in the last 6-8 months.
Yeah, it really is. But like, so like kind of add this. So I was pretty heavily leveraged into QQQ and SXL recently. And so the point is that, I kind of like, when I have invested, I'm watching pretty carefully. If there's, sign of a downturn, I am out of that thing as fast as I can get, because it's just, once you take loss, I think I did math on this, is, if you go back a couple of years or something, you like did the, like a back test, I think you only come with like 2x gains rather than 3x. So I think my bottom line is, if you want to, I guess, day trade, or you want to be like an active investor and you want to watch it for a long term, and hedge yourself for like SQQQ, like, if it comes out to be a red day, or with puts, that's something you can do. But it wouldn't seem like you to set and forget it, because like that's when you take massive losses in a bear market.
Okay, makes sense. Thanks, guys.
And you could just buy the underlying on a levered basis. I'm assuming you can get a margin account, in which case it's just cheaper to do that. If you really want 3x exposure to something, just buy on margin three times your account. Not financial advice, and also don't do it.
Got it.
Jian.
Hey guys, thanks for having me. I know people here through the trade group. If people in the trade group know, I generally buy whatever Kush tells me to buy after a little bit of research. But I'm kind of interested in your guys' thoughts about the reopening. So I know that Zoom has basically stolen the lion's share of telemeetings, the same way Google is, how we say, searching on the internet. But I'm wondering, as reopening continues, like how good of a short candidate is Zoom? Given that it does have the lion's share of, or the mind share of a lot of companies, is telework going to be something that's going to continue on Zoom because there's a lot of competition. I think Slack and obviously Microsoft Teams are gearing up to, and Cisco WebEx are gearing up to take its lion's share of the business. So given that, like, I think a lot of Zoom is priced on, growth. How good of a short do you guys believe it is? Like, how good of a short is this whole sector really coming up?
I personally don't think that there's much of a future for Zoom, to be honest. I've been saying it since COVID has kind of exploded. They rapidly went up because obviously there was a demand for it with the work from home, coming up and about and everything. But going forward, I mean, the best thing that they came up with in order to stay relevant was to create a platform to have like a virtual help desk person, or like I'm sorry, a receptionist. Sorry. So that's the best idea that they had. I mean, what else can they possibly come up with? They're not going to stay relevant for long, in my opinion. I don't know. I wouldn't invest in them. I would trade them. I would trade them short term. I would ride the wave, but I would definitely not invest in them long term. That's my personal opinion.
I actually disagree with that, Jimmy, with Zoom.
That's perfectly fine.
I just think that nowadays they saw the cutting costs and doing online and different sectors of work, like law firms, for example, because that's my field. And a lot of the law firms and stuff, they have actually permanently switched to Zoom. And you see all these different companies, whether it's manufacturing or other things, that have permanently just switched to it because it's just so cost efficient. And I think Zoom will just always be there now. If you don't have to be in person, then you won't. And you can even take doctors, for example, like if you have a cold or a sore throat or something, rather than actually going to an office, they're doing these video chats over Zoom. And I think that this is actually just the start of Zoom. Like, people have realized the efficiency with it and the amount of costs they could cut.
That's absolutely a possibility, right? Because I mean, if there is a complete change in culture like that, because I mean, if people are comfortable with that, great. But I mean, when it comes to business and things like that, I still think that there's still something to face business that you can't really get over telecommunications, and that's just my opinion. Maybe I'm kind of old-fashioned like that, where when it comes to business, you kind of, I think a handshake and actually face-to-face interaction is still important. Um,
Yeah, I mean, I'm probably as old-fashioned as they get, but we're seeing a pretty large shift, even in an industry like banking, which is what I would view as an extremely old-fashioned business. You had HSBC announce that essentially half their employees are going to be working from home, and there's going to be a place for these remote conference type applications going forward, regardless of whether COVID is here or not. Everyone is searching for the next cost cutting, cost savings initiative that they have. And so going forward, even if it's not prolific to the extent that it's everywhere, it could maintain. So I wouldn't necessarily consider it a short candidate. I wouldn't invest in it personally myself because I don't really know where it's going. There's uncertainty there, but there is something to it where I'd be a little bit hesitant to short the industry or short the business itself. And that being said, telehealth is a really big thing right now in the M&A market. You're seeing tons of telehealth deals out there in the middle market right now.
I mean, take universities, for example. Like, why do you think right now so many of them have chosen to stay closed? I mean, it like, you can easily social distance a classroom or whatever, but if you can do the same exact thing online via Zoom and save those costs via electricity or all the other costs that come along with having students indoors, why would they keep it so long? You have to think about that. And like I said, the whole doctor scenario, like when you go to a doctor, like I just had an annual checkup and that was over Zoom, which doesn't make much sense, but that's just kind of where they're shifting nowadays.
I kind of agree with that. I kind of don't, because at the same time, not many businesses or educational institutions are selling their brick and mortar locations either, right? So like they're still incurring costs there. It's not like they're cutting costs completely, right? So
where I came out on this was I did a analysis of it, and I realized, yes, video conferencing is here to stay, likely here to stay, very prevalent. I have about a dozen video conference meetings per day now versus a year ago maybe one per week. but ultimately the proportion of meetings that are initiated with Zoom is less than 20%. Hangouts, Teams, Blue Jeans, there seem to be more prevalent than Zoom, at least in my industry, and also with at least my doctors. My doctors have their own proprietary apps, or the hospitals have their own proprietary apps, and the back end of it turns out to be Google Hangouts when I looked into it. And so where I came out on it is, yes, video conferencing is through the roof, but no, Zoom has no proprietary, beneficial anything to their platform. So, it was a wash, and I said, okay, I'm not going to take any view on it.
I just want to add something. Sorry, I'm in a different industry. I'm more in the creative side. I'm a producer, and we do a lot of video editings. And I think the fact that Zoom is able to let you work on, creative projects with other people and screen share, that cut like so much cost for a lot of us as artists and creatives, especially when it comes to working with third world countries or places where it would be impossible to meet, and it would just cut so much time from sending projects back and forth, especially when it's huge files and folders that you can't like easily just share between each other on text. So you kind of have to be sitting at your studio and downloading it. And I think as technology moves faster and the internet becomes faster and all over the planet, I think Zoom is just going to get stronger when it comes to that side of the business. So I don't think Zoom is necessarily a long-term investment. I think most of it is already priced in, but I think it's definitely something that's going to be here to stay.
Yeah, I don't think it's going to become irrelevant. I don't think that's not what I'm trying to say. It's absolutely here to stay, right? Telecommunications altogether, but in terms of the rate of growth that we're seeing right now, that absolutely cannot sustain itself. I think it's completely overvalued for what it is, and that's where I'm saying it's not investable.
Yeah, let me just say something real quick. Let's not conflate Zoom with the concept of video teleconferencing in general, right? There are so many competitors and products out there that can do exactly what Zoom does. I think Elle was just talking about that. Microsoft Teams, for example, can do everything Zoom does, and it's packaged as part of their Windows platform, right? And so you kind of get it for free when you license Windows. So I think the point is that yes, the idea of video conferencing and collaborating in that way is probably here to stay. I would agree with that. But I guess my opinion is that Zoom doesn't hold any special value or consideration when it comes to that. There are so many competitors out there that do the exact same thing, and I would argue and say that they might do them better. So I think that's kind of maybe the point that's missing.
I'm glad you bring up Microsoft Teams, because there are so many businesses that see Microsoft Teams as a professional source, at least more professional than Zoom or other competitors.
Absolutely, I would agree with that as well, because they have a whole suite of products that come with that license, right? So like when you get a Teams license, you're also automatically an 365 member, right? So like you have all the Office products, you have Teams on top of it. I just think that there's more there than Zoom.
And don't discount, this is going to sound funny, don't discount Apple FaceTime, because they're working on it, and they're very much putting a lot of R&D into it, and a lot of creatives. Someone mentioned that they're a creative. I'm assuming you work on a MacBook. And I've read a lot about the effort Apple is putting in to kind of take down Zoom, and at least within the Apple ecosphere, have a product that does all your needs, has all your video conferencing and work from home needs totally integrated within your iPhone, MacBook, etc. So I've read quite a bit on the fact that Apple is really putting R&D and looking to revamp FaceTime.
Let's also consider the hardware that Apple is aiming to present. I believe at the end of the second quarter, they're aiming to actually release an affordable screen, right? I think a 32-inch screen, if I recall.
Some great points. We are at the top of the hour, so the last two people that we have invited on stage will be our last two questions. Chris, you can go.
Hey guys, I'm Chris. I'm I guess what you call like an old new investor. So what I mean by that is I've had long positions for decades, but never actively looked too much at them or did the whole Robinhood thing until recently last year, and that's really because of Tesla. So I've had Tesla just because I think it's been a brand that I think has one of the highest quality products ever sold. Something I felt very similar about Apple. We were talking about like decades ago. Anyways. Because they've essentially just drilled up for a year, I now think I'm now a genius investor. Obviously not, but really weeks like this are kind of scare me because they remind me that maybe the party is probably going to end soon. So, anyways, my question is, what are your thoughts on positions that might, grow very, very large very quickly and kind of outweigh in your portfolio? And how do you make like sometimes hard decisions that it might be time to break up with them sometimes? Even if your thesis is still intact for that position, do you just hold forever? I guess, are there red flags that might mean that you're over levered? Not really sure if there's an answer to this question, but just looking to get some of your thoughts on this type of scenario.
Does anyone want to answer?
I actually have a strong opinion on this question, if you don't mind me answering.
Oh, hello. Hi. Sure,
Hi.
go ahead.
Yeah, so if a position becomes like an outsized portion of your portfolio, I don't think it's necessary to liquidate it entirely, like if you want to capture more upside. So I think Bitcoin would be a good example, right? If you hypothetically bought like Bitcoin with 50% of your portfolio several years ago, and now it's approaching like 100% of your portfolio value, by doing nothing, your kind of volatility grows as a percent in terms of percent returns. So what I strongly believe is that you can kind of like sell off a portion of it so that it's once again 50% of your portfolio. And that way you can kind of take profit off the table, but still capture some potential upside. And a more recent example of this is like, I got into the CCIV SPAC when it was like trading near par value, and it shot up to like 50 recently, and I like sold off 80% of that so that I was once again like in the same proportion. And that last bit did tank in value, but I took enough profit that I'm happy with this decision. And I did pretty much the same thing for GameStop, where like I was in since it was at 20 and like rode the wave all the way up, and I was still holding the bag at 300, but on the way up I sold enough shares that I kind of kept GameStop as 10% of my portfolio. And even though I was holding that bag, in the end I took more profit than I was risking eventually. And so that's how I would generally manage this.
I think overall, if you have like a certain thesis on a certain company, like for me, like I've been in this biotech company known as CRISPR for over 2 years now, and I first like averaged in at like $40 like a share, and then at their peak they touched like $210. But I never sold like any shares until very recently, because overall, like if you think about the thesis of why you, like if you're playing stocks, like why did you enter into that company? If the thesis is still being satisfied and you're still the company is still like the fundamentals are deteriorating and the thesis you have is still getting progressed like over time. Like as I look at CRISPR, their trials are going well, their cash position is still strong just in case anything happens. So there's no reason to really like necessarily sell. You could just keep on adding on, because in reality, if you're aiming like long term, you don't need to get into every big play or every amazing company that comes onto the stock market that you see on the news. If you just find a handful of really amazing companies, like you really grow your port, and then that's all you need. Like for example, people who found like Walmart, like the older people who found Walmart back in the day, like if you sold Walmart when they were only like when they went from like a couple of states to like 10 or 11, if they sold a lot earlier than that and they didn't wait until Walmart was like fully nationalized, then they missed out on like a huge amount of gain. So if you have a certain thesis on a company and they're growing over time, just keep on looking to keep on adding on as long as your thesis is the same and the fundamentals still remain, in my opinion.
Yeah, I guess what I'm saying is that if your thesis is still the same, then the thesis that caused you to put like 20% of your money into one stock should mean that if the stock grows until it's like 50% of all of your money, then from a risk management point of view, and I guess that's the theme of this room, you should sell off some of that until your percent is down to 20%, because like your thesis didn't change that. It's somehow suddenly better because it went up, right? Assuming that the thesis is the same, in my view, it should always be like 20%.
Yeah, I think that's a great point. It's like the whole idea of like trimming for profits on the way up. And then I think for long-term positions, you can definitely use technical analysis to help with, when you want to buy in, average down, or when you want to trim for profits. I was also in the CCIV train, and I was luckily also sold like most of my position at around 60. But also I think with the whole SPACs and the growth of CCIV is like a special. It was more of it wasn't like because it had strong fundamentals. It was more like there was a lot of rumors and it kind of pushed it up really, really high in a very small, short amount of time. But all great points. Chris, did that answer your question?
Yeah, that was great. Thanks, guys.
Awesome. Okay, well, 5 minutes over. This was really great discussion, guys. I also learned a lot. Thank you, LT, Jimmy, Ryan, Daniel, those of you who didn't join us last time. I'm excited to host these rooms in the future and have more thought-provoking conversations with you guys. Thank you, everyone, for tuning in, and see you next Thursday.